Welcome to TradeTheMBI.com. This is John. This report is for the 3rd of November, and you can see we started out with our warning here in this little magenta. The biggest trouble that we see is that we're going to end up with a much lower shakeout than the previous one, that we didn't go negative and completely reset it. Means that it's still valid, that we're having what you would call matching our higher highs on lower histogram, which means we're going to have a pretty good retrace all the way at least back to the 25 range when sell signal comes. Now at this particular point you can see short-term buyers are up, mid-term buyers skyrocketing through, long-term buyers are just maintaining flat around the zero line, but shorts taking a huge dump. I mean, that last time we saw that was right over here when we had this massive pump right there, and there's not a whole lot of fundamental reasons to short or just hold is really the situation at this particular point, because you still have all these positive economic numbers coming through, and it just keeps going. And even when the ones that are sketchy after the hurricane, it still points to growth. And in a growth aspect, you're going to get ranges, but you're most likely going to just see these sideways periods with bursts. The problem with that is that if you're not positioned, you're going to miss those pops like this one here. As we were going, it was preparing to see the reset taking place, and then boom, crossed over and immediately jumped. And that's where a lot of people miss it, because they're just afraid of what the value is, because they're told that that's too much or this, that, and the other. And that kind of talk is usually what keeps people out of the market and causes them to miss, because they have a preconception as opposed to just following what is. Again, the euro basing here, there's no impetus for it to drive lower or higher. They're keeping it just outside the range here that we were looking at, simply because that is perfect range to help support the S&P, and certainly is overvalued in my view, and helps trade with the U.S., which is designed to support the U.S. for the most part at the European expense, I think, but that's a whole different issue. Not really relevant to whether or not the market is moving, but it is interesting to note we're not seeing any major central bank swings or anything, so they're pretty much content, both sides, with where that is at this particular point. Crazy rise in bonds is still bizarre. That there's obviously some expectation that rates are going to remain the same or go zero, or because of the new Fed, or people just really are buying because they're afraid to put their money in the market. And that's an interesting aspect, because it means there is a significant amount of money on the sidelines capable of moving into equities. Yeah, keep that one in mind. Particularly on a dip would be an opportunity. Now, if the Fed has to go ahead and raise rates because of a heating up economy, it's a double-edged sword, because every little quarter point they increase makes a massive increase in the deficit. Just so far, the $300 billion increase in the deficit was strictly from increase in interest rates, and that's what happens when you have a $20 trillion debt. Oil, again, up at the peaks. Saudi Arabia and a lot of the OPEC places going to be happy with these price tags for the moment. It's been a solid rebound. I think it just points to the broader economic conditions. It's not about supply, so there's plenty of that. And gold, not going to rise until we see rates start to climb, or the real specter of inflation, which, if we're going to see it, is probably not going to be until the beginning of next year. And when it starts, it will accelerate quickly. Particularly in wage. That's really what everyone's going to be wanting to watch, is wage increases, because that's really the driving force of inflation. If you have a tight labor market, you're reducing immigration, that kind of thing, then theoretically overall wages would have to rise, unless you're just outpacing with growth the number of people you can hire at a time, and creating that bottleneck and making the demand for people. That hasn't happened since the 80s, so we'll see if that turns around and takes place. It was an interesting day. It was just choppy. We ended up with the bounce. We came back down, tested the lows, reset, went back up to the 50%, and once we stayed back above it, that was the final marker, and then we ended up just pretty much ending flat with where we were in the previous close. So nothing too dramatic, but it did give enough range to play with, which that's what I was talking about. We're starting to see a much bigger range overall, which I think is good, because that volatility is going to add not just to participation, but it's also going to mean you have a stronger price discovery. And that's important, because low volume is always scary, particularly at peaks, because you don't know if the weakness is systemic. So when you see broader ranges and decent sized volumes, then you're at least saying, okay, at least everyone's generally in agreement on where things should be, and we get an equilibrium. So all in all, it's fairly good. So we'll keep posting anything as necessary. There wasn't a whole lot going on to have to do anything with this one. I still think that we have a slight upside bias. Like again, if we push towards the 85 number, I would expect us to make it to 26. We'll see if that takes place, and we don't have any change in the reading. The degree of short drop off on the daily, though, can be problematic, because it means that you just have to have new buyers to drive it. And we're reaching the fourth. Will we see earlier buyers jumping in here before the beginning of the week with the new fund money coming in? So there's going to be a whole new supply of liquidity. Yeah, so a lot of interesting stuff. As always, trade well. We'll talk to you later.